says. A lot of times those are two different things. We're going to answer that question in 3 steps. Step number 1, the Buffett gauge. This is how he likes to measure whether or not the stock market is cheap or expensive. It's the total market cap relative to GDP. There's a chart going back to 1975. Editor will throw that up on the screen right now. In 1975, the market cap was under 50% of GDP. As we go through this to the 90s, it just skyrockets all the way up till we get to the peak of the bubble in 2000, where we are at 150% of GDP. That's really a tough number to get your mind around. Of course, everything crashes, as we know, and then it climbs all the way back up to around 135% of GDP, and then it crashes again in 2009. It bottoms out at its historic trend line in 2010, but then it goes right back up, and now we're at a point higher than we have ever been before. Now you may be asking yourself, how on earth can we go through a time frame from 1975 all the way to 1990 where the market cap was under or right around 50% of GDP, and then all of a sudden, just a couple decades later, we're all the way up to 150%. Why on earth would anyone be willing to pay so much money for stocks here when down 1975 through 1995, people seemed far more prudent with their money? It boils down to 2 major factors: interest rates and liquidity. So if the Fed's printing money like mad, injecting it into the system, a lot of that money is going to go into the stock market. That's going to drive prices higher, although the fundamentals don't change. Additionally, interest rates. Because stocks are valued partially on future cash flow, the lower the interest rate goes, the higher the projected future cash flow actually is. So it would make sense that stocks, when interest rates were 15%, would be down below 50% of GDP. And when interest rates are at 0 or 1%, then the stock prices would be all the way up at 150%. The problem with this, and what most people forget because of that recency bias, is that interest rates are cyclical. If you go back through our entire history of the United States, interest rate cycles go up and down, usually in 20 to 30 year periods. Currently, we are 40 years into an interest rate downtrend. That's very long in the tooth. So what happens when we go into a cycle, which we will go into again, where interest rates start to increase? Well, if this is our mark at 15%, this is our mark at 1%, it's safe to say that even if interest rates normalize and go back to 7%, the market, the stock market, would lose at least half of its value. Since cash gives you an option to buy things when they're cheap, it would be safe to assume that Buffett would have very little cash in his portfolio in this time frame because he'd be buying as much as he could. He would have a lot of cash in his portfolio here, a lot of cash here, and a ton of cash here. That means the more cash that he has, the more he's expecting the market to go down and get cheaper. Let's look at his cash positions right now and see if that's actually true. Step number 2, Warren Buffett's cash positions. This reveals a lot. Remember, Warren Buffett likes to buy things when they are cheap. Remember, that's my number 1 principle in my personal investment philosophy. So if he has a ton of cash in his portfolio, and this represents the percentage of cash that he has in his portfolio, that would imply that he just cannot find anything cheap to buy. Back here, 88 through 96, he was almost fully invested in the market. That means he can see a lot of cheap things out there, so he's buying all the time. He doesn't want any cash because that's counterproductive. But in 98, he starts increasing his cash positions. That was when the NASDAQ bubble really started to get going. And of course, that bubble burst right around 2001. What's interesting is Buffett's cash position prior to the crash went down substantially. And you may say, well, boy, maybe Warren Buffett's not that smart. Maybe he should have stayed in cash. But what happened is he saw that value stocks at this time were incredibly cheap. They weren't in a bubble. It was all the other tech stocks in the NASDAQ. That's what created that huge bubble that ended up crashing. So Buffett was loading up on value stocks right here, which did very, very well. But coming into 2004, we get to a point where he doesn't see anything that's cheap. This is historic. Over 60% of his portfolio was in cash. That means something is really wrong with the price of the stock market, according to Buffett. And again, he might not say this, but his actions tell us the truth. So moving on to 2008-9, that's when the stock market really started to crash. And Buffett went on TV. He was on TV all the time saying that now is a great time to buy US stocks. Well, it wasn't that great according to his portfolio, because historically he had been invested almost 100%, but he only went to about 75-80% here in 2009. So he wasn't exactly practicing what he preached. Moving forward to today, here 2018 was when this chart ends, he was way up about 50%, but now he's even higher to a point almost where he was in 2004. This tells us that the market is extremely overvalued and the very best investor in human history can't find anything that's cheap enough to buy. Step number 3, putting the pieces of the puzzle together. This is Warren Buffett's current portfolio. Financials is at the top of the list with a 45% allocation. Next is tech, 26%, going down to materials at 0.3%. Let's think about this for a moment. What happens to financials when interest rates go up and down? If interest rates go down, especially if that yield curve flattens out, it's a lot harder for financials to make money. If that yield curve steepens, if long rates go up, then it's easier for financials to make money. What Buffett is doing right here is he's showing us his cards. He's showing us that he thinks that we're at the end of that interest rate cycle and that interest rates will start to turn around and go back up for the next 20 to 30 years. If stocks are at all-time highs because interest rates are so low, what happens to the stock market if interest rates go back up for 30 years? The stock market gets cut in half. If you thought the stock market was going to get cut in half, how would you have your portfolio set up? Your cash position would be at all-time highs, just like Warren Buffett's is. So if you look at what he does and not what he says, it becomes blatantly obvious that he thinks interest rates are going way up and the stock market is going to crash. For more information like this, check out this content right here, and I will see you on the next video.